More on the markets as a focus turns to the Fed policy meeting next week. Let's bring in Nadia Lovell, senior equity strategist at UBS Global Wealth Management. I'm trying to do some of this math. Welcome. Good to see you. Thanks for coming in the studio. 100 basis points in 2024, which seems like there could be a 50 in there, maybe, to get there.
Potentially, yes. We think that the inflation data is good enough for the Fed to start the cut in cycle. That's obvious. What's going to determine the magnitude and the cadence of that is really the growth data. And we understand the bar is high heading into next week for a 50 basis points cut. But we're not out of the woods yet. We still have retail sales next week on the 17th. If that comes in weak enough, maybe down half a percentage point, that could put 50 basis points on the table. I think right now the Fed remains somewhat non-committal, and a decision will be made closer to the meeting. So our base case is for 100 basis points this year, and a lot will depend on the data. We're all data dependent. If the economic data is more resilient, then it's a bit less. Maybe it's 75 basis points.
You think that they can do it without scaring anyone? That the economic numbers and backdrop would allow for 50 basis points, but people wouldn't say, oh my God, what do they know?
Absolutely. Absolutely. So far, collectively, the data seems to suggest 25 basis points. But we know that monetary policy acts with a lag. So the growth data, if it starts to weak, the job data has been mixed. Yes, weekly jobless claims recently has been more well-behaved. But reality is we're getting some mixed signals from the job market. And the Fed would want to get ahead of that. We're so close to this soft landing. We know it hasn't been achieved many times in history that I don't think that Chairman Powell wants this to slip away from him. So if he needs to move aggressively, we think that the committee will be able to do that.
Bumpy, but 5,900, which I think a lot of people would settle for that on the S&P by year end. That's a good move between now and the year end.
It is. It's been a good year so far. Yeah, that's our target. It's been a good year so far. Things are a bit choppy right now. The market, of course, is trying to discern, the macro data and whether we're on course for soft or hard landing. As I said, we think that we're on course for soft landing. I think what's encouraging is that the consumer remains resilient, and corporate commentary so far doesn't suggest any sort of broad-based slowdown. So the economic data and the earnings data is looking good. I think also what's encouraging, you're seeing this broadening out of the rally. Let's talk about, it's no longer just a mega cap tech story. You have financials that are outperforming utilities. And we all talk about that one semiconductor stock that's up over 100% this year. There's another stock that's up over 100%. It's the utilities. And so that's encouraging. We think when we put all that together, you can get to 5,900 this year. Some chop around along the way, though.
In housing, recovers because of the lower rates and the broadening of AI, not just NVIDIA. You think you can find some other names?
You're seeing that already, that utility that I talked about. At the end of the day, you've heard Jensen talk all week about they're chomping at the bit for those for his chips, but you need utilities, the electricity to light up. And so you're seeing utilities as being part of that AI story as well.
Okay.